Good afternoon, everybody, and welcome back to Markets for Millennials. After a few weeks off, did not get a chance to do an update last week because I had an operation, and so that was why I was MIA on YouTube. I was on Twitter, but I'm coming at you today shortly after the close of the New York session, New York Stock Exchange session here on January 14th, and we're starting off with the DXY. Now, a lot has been happening. The last time that I posted a video was on December 17th, and that was when the dollar was right here. If you just look at where my crosshairs are, and ever since then we failed. We made a wick higher high. Well, almost a higher high. No, we did not make a wick higher high. Excuse me. We failed to make a higher high, and instead we're consolidating sideways. And then we made another lower high and then broke down. And this is kind of a pivotal moment. The DXY appears today to be closing above this trend line. We actually did come down and close below it. If we come down to an 8-hour view, you can kind of see that. And this was our first retest, so this could be just a fake breakdown, or it could be the start of a new trend. This is always where you have to be really cautious in your technical analysis because here we are since May of 2021. The dollar has been respecting this ascending trend line as its kind of bottom support on this in this trend for the last 7 months. And when that kind of trend line is broken, not something that's a few days or a few weeks, but when you have something that's a half a year, and that breaks, you have to really think about, okay, is the trend changing? Like, has the trend completely changed? Even though we're getting that pop up, this is where you must be cautious. So I tweeted about this as the DXY was coming down into this support on January 12th, that even if we break down, what you really need to see to guarantee or to know that it's more likely that this is an actual like major trend change, you want to see this close down below this trend line for at least a couple of days, if not at least a week. And obviously we've only had really one true close below on the daily chart, and now we're right back up within. So this is to me, this is where excuse me, to me, this is where if you took long dollar trades, and granted, like if you were to go to Forex, if you're trading Forex and you were taking long US dollar trades, then this is where you kind of have to consider making sure that your stop losses are at break even if they haven't already been breached. And you just have to be ready and willing to accept that the dollar may move totally against you. This is also not the opportunity. So what I was going to say was this is not the opportunity to take new trades, whether no new long positions, because again, this is cloudy. If this was had been like a clear stop here on the 12th, if we so we kind of slightly closed above it. If we had just bounced on the 13th and then continued and followed through on the 14th, this would have been more clear. This would have just been okay. This is just a reset of the trade. Your long U.S. dollar trades can continue, but in this case, it's a little bit more murky, and so no trades to the upside or to the downside. As a matter of fact, what I would say is, if you're going to take a trade, something's wrong with my lines. I don't know why they're extended like this, but the first place I'm going to be looking at is I think it would be safe if you got a breakout and retest of this trend line, or if you want to take a more shallow approach, maybe something like this. I don't really like that one as much. This is definitely more conservative, but I'm going to get rid of that. So to the upside, you're waiting for a break of this trend line for an entry, or to start looking for entries in the US dollar long if you're trading Forex. And then to the downside, like I said, you really want Nobody's stopping you from taking short U.S. dollar trades, depending on the currency pair, because not all the currency pairs that are paired with the U.S. dollar are going to trade the same way just because of the DXY. Um, but uh, but yeah, I think you have to be really careful because there's no evidence yet to show that this is actually going to be a long-term trend change. Um, and so you want to be really careful, and that goes for if you are trading um, or buying the various. I think there's ETFs that follow or that track the DXY, track the U.S. dollar index. You want to be really careful taking any longs or shorts here. In fact, I would just stay away um, from that until there's more clarity here. So again, you want to get some really you want to get a solid move and a retest in this area if you're going to take longs, and then on the bottom side you want to see this come back down, and then you want it to resume lower than this low right here. That'll be the confirmation that the trend is continuing to the bottom side. So that's definitely something I'm going to want to watch. So the last few weeks since I last posted, it's definitely been a dollar story. Um, yeah, as I think it was much of 2021, and of course, looking ahead to the rest of the year, you have to consider what's going to happen as the Fed continues to uh, taper, and then are we going to get rate hikes? How many rate hikes are we going to get? And ultimately, nobody knows. And so that's something that you have to be really careful about as you trade. That's why you trade on the technicals. You don't trade on the narratives, because otherwise you'll probably get wrecked. The other thing relating to all of this has been the trading of the 10-year. So again, to go back to where we were, um, this is where we were when I last posted a video, kind of on the bottom end of this new line that I had drawn. If you've been following my channel, then you know that I've been looking at I was looking a long time at, let's see, yeah, it was this trend line, I think. I was looking a long time at this trend line. And then as soon as I started to see perhaps somewhere around here that this trend line was not really that important anymore, I kind of lightened it up so that it couldn't be distracting anymore. And then I waited to see where I could draw the line. And I drew it. I made a choice to draw it to the bottom of this wick from August 4th of 2021, because doing so helped me to catch the December 3rd and the December 20th wicks and candles, and that seems to be a new place on the bottom where you can find some support. And to be honest with you, because we failed to make the higher high in November. And we made another lower high in early December, I was looking actually for this to break down. Um, it seemed as though that was where the trend was going, and just over the last few weeks, it's just been on a tear to the upside. Which I just want to remind you, I did say that is prone to happen, because when you look at what happened over here as we got into late January and into February of 2021. Yields just took off. I mean, it was, we went from, let's see, at the end of January till the top of the yields was, 63 days. Obviously, some of those are not trading days because some of those are weekends. So 45 trading days went by, and it went up almost 80%, so about 76, 77%. So the yields can move fast. Okay, don't think that they have to be that slow moving. Now, the thing that I think is notable is let me actually try to draw a line here, because I want you to see what I'm looking at here. Let's see, let's darken this up, make it green because it's going to close above, it looks like. Look at what the yields are doing. When we came up, we tested the last high on yields, or the last recent high from March of this year, or of 2021, I'm sorry. And what's really funny, I'll talk about that line in a second. But we came up above, but we couldn't close above it. And so I thought that was interesting. I wondered if we were going to get rejected and come back down. But after a few days of kind of retracing, we've today, we're up over 4.8% on yields. It's a really, really big move for yields. And where it looks like, unless something changes in the next 40 minutes or so, it looks like we're going to close above our last high. And so that, I mean, the sky is the limit. There's a lot of people talking about, um, how high can yields go before the Fed is forced to take action. And I've been on this channel saying that, 2% is kind of my line in the sand. I want to see what happens as yields get up to 2% because I want to know if when it gets to 2%, if we start to see the equity markets coming off, and what extent it has on just various markets in general. Um, Definitely, I've got this blue line up here, and some of you who have followed my channel might remember that I had these long-term blue lines. It turns out that I had to fix some of those. I had one that was quite a bit lower, but it didn't actually work out properly in terms of actually finding resistance long term. But this line is solid, and so this line is coming in, from today, between the 2.5% and the 2.45% levels, and so that's going to be another level that I'm going to be watching right there to see if yields get kicked back down there. Nobody really knows, but now that I'm going to erase that. Some of you, again, who have been following me, when we were making this, after this kind of consolidation, we were moving back up. As we were consolidating here and moving up, I drew this line, this yellow line, because I thought that I had said that that was going to be my important line for yields. And even though this has happened months later, it's still important. I'm going to get rid of that. So here we go. We might be off to the races in yields. So having talked about the dollar and yields, let's look at the equity indices. And we just continue to have these dips bought. However you want to draw your lines, every time the lines have come down and we've had a significant correction, I wouldn't even call these corrections. Anytime we've had a pullback and I've redrawn the line to account for some other bottom area, we've got, this was support all the way up, support. We've got wicks down. Like the last couple of days, in the last week or two, we've had a lot of really solid wicks down. I think this was an interesting wick right here from the 10th. That was, I think, on Monday this week. That was really interesting to me because a lot of people, I think Zero Hedge and maybe Bloomberg and CNBC, a couple of different groups or people were talking about how the indices were coming down to significant levels. So we've obviously got a close below the 50-day moving average on the S&P 500. But this spot has been traditionally a place where people have bought, right? Going back to since we started the, post-crisis, recovery, every time we've slipped down to around the 50-day moving average or just below the 50-day moving average, it's been bought up. And so I don't see anything to suggest that this is going to be any different, with the caveat, excuse me, with the caveat that we still don't know truly what the Fed is going to do. So that's definitely something that we all need to be aware of. And so on the S&P, you can see I've got these. This is probably worthless. I should probably move this up here. Maybe move this down here because it's really kind of this whole range here that we're trading in, but still to the upside. But we've got the S&P. It's not that far off of its all-time high, of its most recent all-time high. If I go from the wick, we're only 3.1% down. And we had that huge dump in the middle of last week. But honestly, still doesn't look too bad. If you're DCAing or something like that, or if you are looking for like typically good support to buy off of, again, that's a good spot. So what you would do here is I think you take a partial position. Again, whether you're doing futures or if you're buying SPY, um, I think it's SPY or maybe SPX, whichever the case may be, maybe take half your position right here or a quarter of your position here. And then as you start to get follow through and confirmations, then add to that position and pyramid that thing so that you can maximize the potential profit there. On the NASDAQ, this one I remember vividly on Monday this week that there were all these articles talking about potential crash, potential crisis here because we had, if you see how far down this wick is going, this yellow line is the 200-day moving average. We were getting very, very close to it. The last time I think that we got that close to it, see if you come back here, when we had the February to March 2020 crash, we really sold down and then kissed it, came up and bounced off the 50-day, and then came right back down and just went right through it. And ever since then, April 2020, we haven't really been ever that dangerously close to the 200-day moving average. So everyone was freaking out here. Now, the thing with the NASDAQ is it's much further off of its all-time high than the S&P by almost double in terms of percentage. And so, like, if you look at this chart, what you're seeing here is lower high, potentially lower high. It's possible this could come up here, and I'll be watching this spot off this trend line to see what happens. But again, like, I have not seen anything to suggest that this is going to be a crash anytime soon. In fact, as I'm looking at this, wrong thing. As I'm looking at this, I'm almost wondering if I can do this live really quickly. Let's see here. Try to do this. All right, see, look at that. All right, look at, and obviously, again, today we were down below it just like a couple days ago, but we are closing above it. So this is the spot. Again, this is a really strong support spot, and it has been going all the way back. So definitely something that you'll want to pay attention to and you'll want to consider. Probably actually need to adjust that right there. That looks a lot better. So NASDAQ between the 50-day and 200-day moving average on the support line. This is actually probably pretty close to the 100-day. I don't have that preset in, so I'm not going to take the time to look at it. But you can start to see the 50-day moving average is curling towards the downside. That's not necessarily good in terms of short-term momentum, but obviously the long-term moving average is still pointing up. But you have to remember the NASDAQ is full of names that were bought during the obviously during the time where there was easy monetary policy, and monetary policy is changing potentially, and so higher yields are going to be something that's harmful. Tapering is going to be something that's harmful for the tech stocks, the ones with the ones that have been mostly played, that a lot of people have been playing for the last 2 years since the COVID crash. And so that's something you have to watch out for. But again, if you're a believer that things aren't really going to change all that much, then this is the spot to buy it because it traditionally has been going back all the way from the beginning. So next one is the Dow. The Dow looks the best. The Dow is staying above its 50-day moving average. And I don't know what's up with this trend line. If I do this, it looks a little bit better. Right, so staying above both of its major moving averages, the 50 and the 200, staying above this trend line, which I just now adjusted for this wick right here. It's still above it, made a higher high. I would say that this is very similar to the S&P. You're not very far off your all-time highs, just under 3% off the all-time highs. So everything there is looking okay, much stronger position. And the Dow honestly is full of industrials and financials, and it will do better in a higher interest rate environment. So even though it's down today while the NASDAQ is up, the prospects in a tightening phase are better for the Dow than they are for the NASDAQ. Now the Russell, I tweeted about this earlier. This is really interesting because for the first time in a really long time, it's possible that we get a cross, like a true cross, depending on what the price action is on the Russell of the 50 and the 200. You can see right here as I zoom in, we nearly had a perfect. We nearly had a cross here, but then that was when the Russell had its what was supposed to be its breakout that I had been talking about for a long time last year, and it ended up being just a prairie dog fake out, and then we came back down. And I've tweeted about it a number of times that this is the danger zone, this yellow trend lines. Let me get rid of this for a moment. Try to lighten these out so that it's not obstructing. This yellow trend line, this is the danger zone because it's provided the support all the way across since January of last year. And I was a little concerned because it was about 10:30 or 11 or so. We were at the very bottom of this, what is now a green wick. It was totally red, totally solid all the way down. And just in the last 3 hours or so, it has come back up and it's closing above that line, but still lagging and not doing so hot. So, but again, if you're a believer that the indices are going to go up and that the Fed is not going to actually change and they're not going to do the things that they continue to suggest that they're going to do, then this is the best buy spot. This is the best buy spot you're going to find. Like, as far as, because it's provided all of this support. And I'm not saying that you can't wait for a pullback, but the only problem with that is that you could see price come back up and break up, and it could go, it could take off after that. And then the pullback might end up just being to the upper part of the range that we've been in. So again, it's one of those situations where on all of the indices, if you're interested in taking long positions, you take a partial position so that you don't put all of your eggs in at one time. And then as you get confirmations on the way up, as you confirm back above the moving averages, as you confirm back above the upper trend line of this consolidation, as you confirm above the new all-time high, right? Those are places to add to complete your position. So hopefully that is helpful for you. Let me turn my moving averages off. Take a look at gold. I think I've been on this. We're on like 22 minutes or something like that. I tweeted about this recently. I don't have my Twitter pulled up right now, but I'll say it in here. I'm starting to think that gold is about to have its time. Specifically, we had this, we had the run up above 2000. We had the big consolidation down. We had the double bottom here. We had the first attempted run, which got smacked down. We retested the swing low, and then we've been kind of bottoming out here. And what I mean by bottoming out is, after this area, we came up, we started making some lower lows again, but the lower lows started getting more and more shallow, and then we started making higher highs, right? This is not a higher high over here on the right side, so don't hear me wrong on that. But you can kind of see, like, when I see these sort of rounding patterns on the bottom, that's to me, I mean, again, not acknowledging this part, this to me seems like we're bottoming out and getting ready for the next move. So the question is, where do you get confirmation that the move is starting? So this is where, again, you have to make sure that you do really solid TA. And I'm going to try to do my best here to share with you kind of what I'm thinking. There are a couple of ways that you could look at this. One is you take the top from the 2000 level, you draw the trend line over. I don't know if I actually got the top there. I don't have the magnet on right now. But you kind of do something like that. This is what I've been doing all the way over, drawing some trend lines to cover each time that there has been an attempt to make a new breakout. Keep adjusting that trend line. So now we've got this trend line. We're not actually too far from it, so we could break above this and retest and resume off. That would be a potential spot to do it. Another potential line that you could draw, perhaps. Let's see how this works. Let's see if we can do this. It's not. I don't like it. Yeah, I don't think I like it. Maybe if we go here, this looks a little bit better because we got this little pop up above here, but we got this top and this top. This would make your entry come in a little bit higher off a retest. So instead of on this line, you would have to wait to pop above this line and retest and resume and make a new higher high. I'm not fond of that one because it doesn't take into account price action from up here. So I'll delete that one and I'll keep this one just as a reference point for the future. But one thing that I do want to say is that I think that in certain markets, horizontal trend lines are much more important than in other markets. So I would say that's true in gold and silver for sure. I think that these levels are important. I think that the most important of these levels is probably 1916. I'll be watching for when gold comes above 1916. I'll feel a lot better about that because then getting above 1916 will make a higher swing high from our May into June kind of spot where we came to a near-term top and then got sold back down. But that's the thing. Like even if we get the breakout of those trend lines that I was talking about, gold still has other resistance that it's going to have to get above, and I think that resistance is important. But I'm starting to think that this is it. So I think that the trend is about to change to the positive for gold. So you could play the futures or you could buy GLD. I am personally staying away from miners, but if you're into miners, then by all means, now is probably a really good time to buy the miners. And then obviously buying physical before this price action takes off is a really good idea. Just to have some gold in your portfolio so that you're kind of hedging against everything else breaking, including every other thing like Bitcoin or whatever. So to silver, kind of the same story. The silver story has been sideways, or silver has been sideways this whole time. That's been the story the whole time. We've been spending quite a bit of time in this like low area where actually I want to keep that trend line there, darken or lighten that one out, because I really want to mostly just capture the actual space of this consolidation range. Same thing with silver, except it's a little bit harder because the tops that you would draw your line from are straight across because it's a literally almost perfect sideways channel, except for recently where we've been getting this series of lower highs, and this specifically on a swing trader's perspective, this swing high right here. So I've got this trend line, but I'm seeing the same thing in silver that I am in gold. So we're slowly kind of rounding out the bottom right here. So I'll be looking for a break and a retest and a resumption there. And then my horizontal levels, because like I said, silver is similar to gold, and in that I think the horizontal levels are much more impactful than some of the other things. The horizontal levels, if I just pull back here, that I'm going to be watching the most are going to be around 24. Actually, hold on, let me see. Around 2560. I think that's about the level that this resistance is at. And then the next one after that will be around the 28 level. And then obviously the previous high from, I guess it's from that spike in early 2021, which is around 30. So those are the most important levels, but obviously there are lots of smaller levels depending on how cute you want to get with your horizontal levels. Again, really good opportunity to buy into the futures potentially, SLV, or any of the miners. That would be my view. I'll take a quick look at oil because I think this is just a really good story. The last time we came up to this level, the Strategic Petroleum Reserve released a bunch of its oil, and then obviously we started getting into the winter months and um, started talking about new variants, Omicron, and all that. So um, we definitely did get a bunch of different bearish news that ended up bringing us down to these levels. And then obviously, like I drew this trend line, we actually didn't even get a good retest of this trend line. So that could possibly mean that my trend line was not good. But you can see the rise here that we're getting is very similar to our rise from August into October of 2021. It's very similar. And we're just on the cusp of making a fresh high. Um, it doesn't look like we're going to get quite there today. The last high that we had around here was November 9th. Um, Obviously, if you pulled back, oil has been higher, right? Obviously, probably a lot of people remember in 2008 when oil went berserk. Um, but uh, but yeah, so it has been plenty higher than this. But as far as our recent price action, it's been, let's see, when was the last time we were at these levels? I'll go back to 3 days so I can kind of see. Last time we were at these levels was in 2014. So this is pretty crazy. It's something that, again, like you missed buying. So this is not a good time to start buying and adding positions if you're into trading oil futures or if you're looking to trade energy stocks or things like that, because you've already missed quite a bit of the move. So you, in this case, because you're kind of about to break out to new highs, I think what I would suggest potentially is you watch around. Wow, that was really bad. You watch around this level, and you try to get above it, and then get like a retest of that level, and then you could take a trade there if you want to take advantage of the move. Because there are a lot of people who are saying who believe that we're going to see oil go up to 100 this year or sometime next year. And that move would be almost 20%. So, uh, I mean, what can you do? Like, try to take advantage of whatever things that you are able to take advantage of. And then finally, Bitcoin. People are already calling bear market. I am not personally. I went back recently and I tweeted about this pink line that's across the screen because that has been a key level for a year. Literally a year was resistance when we came up on the run up at the end of 2020 and into 2021. Uh, it was resistance after we sold off in May of 2021 a number of times. Uh, Tested it as support in September after we had the bottom. We came up in wave one, and now we're testing it here in this wave. So a lot of people are looking at, oh, it's going to be head and shoulders. I mean, I don't think so. I think that we're okay. As far as I'm concerned, as much as it's annoying and stressful potentially, and we all want things to happen on our time frame more quickly than they are happening. The reality is that all I'm seeing, based on the original most important trend line in crypto, is I'm continuing to see consolidation in a range that fits that market symmetry perfectly. A lot of people are drawing this line now because we drew this line first, and technically we haven't broken that. We haven't come back down below, so that's kind of interesting to look at right there. Um, but I'm also adjusting the line to right here. So if you were trading, I'm not trading Bitcoin, but if you were trading Bitcoin, you take the entry on the break of this trend line with your stop loss down here, but you would have been stopped out probably, and then you wait for the next entry, so then you move the trend line right there, and then you're waiting for the break of this trend line. But that trend line may not mean much. I think that these at least for the time being, until these lines prove to not be important, I think they will continue to be important. So I'm going to continue to pay attention to them. I'm still bullish on Bitcoin. I think that it's all likely that you may not see this level again. Like if we do end up having a blow off top in Bitcoin over the next few months, which is what I think is going to happen, I still think we're going to get a blow off, even though a lot of people have kind of cast that aside. Then my view is that probably the level that we're at now is probably where the bear market low will be. And so we'll just see. Time will tell. And so that's my view. That's where I think the trades are going to be a little bit more safe and secure. Um, and so I'm going to leave it at that. If you've held on for this long and watched, I appreciate it, and I'm grateful for your continued support to the channel. Go ahead and like and subscribe and share to somebody who you think would benefit from the analysis. Follow me on Twitter at Mr. J Thomason if you're on Twitter. And yeah, consider following along so that you can see the work that I'm doing. Hope you guys all have a great day, and I'll see you guys next week.